How's it going, everybody? My name's Antonio, and you're about to watch or listen to the third episode of the 2023 Outlook series. This one, I am joined by Tom Luongo, but who I'm not joined by is your financial advisor. And this is going to be a conversation that is general and impersonal in nature, and one that will not include any financial nor professional advice of any sorts, but is going to include a lot of forward-looking statements and speculations, probably, that you shouldn't blindly trust, and you should always double, triple check what somebody on the internet says, especially after that Greta video. Tom, did you see that Greta video?
Oh, I did. It was hilarious. I mean, Antonio, we live in a world of fake everything,
Hmm.
and because of that, absolutely, we're all just guys on the internet with an opinion. Salt us to taste, as I like to put
Hmm.
it.
There's this
So,
old journalism saying, if your mother says she loves you, verify it. And I've been telling people watching this to be the journalist to themselves. Verify it for
right.
yourself, report back to yourself, because you have the highest chances of caring about yourself. Nobody
Mhm.
else will.
Yeah, well, journalism is as we grown up to believe in it, is mostly dead. So,
Hmm.
we really have to think about it in those terms. And it's funny, I don't, I balk whenever anybody tries to, call me a journalist. That's not what I do at
Hmm.
all.
I
And
saw somebody called you that though on Twitter recently. You did an interview with somebody. I don't remember who
Is
it
Mel
was.
K. She tends to call me a journalist, and I keep telling her not to, and but it's Mel, and she's a great lady, and that's fine. It is what it is, and I'll ping her again and say, Mel, no journalist, and she'll go, oh, I'm sorry, and then we'll move on, and it's fine.
Well, women would call me all type of things that I don't want them to call me, so I know how you feel. Thank you for being here today, by the way. Thanks for being here today. I
No
appreciate
problem.
your time. And it's not been very long since our last conversation. Still too long for me though. So maybe you can kick it off with your sort of your 30,000-foot view on the economy as well as geopolitics, and like, what are you seeing? What are you paying most attention to right now out there?
So I did, after I was pinged about it on Twitter. I'm like, yeah, maybe I should do a you know top 10 predictions for 2023 post, which I wound up doing first with my patrons and then publicly. And what I'm mostly everything that I see for 2023 comes down to everybody losing their religion, as we like to put it down here in the South, which is that at the end of the day, everybody's got an idea about how they think everything works and their conception of reality around them. Rene Girard calls that, the mimetic collapse, that moment when when the world you thought you knew is not the world you actually live in, right? It's that moment when Neo finally realizes he's in the Matrix and blah, 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 blah,
Hmm.
right? Everybody goes through this at various stages in their lives to, greater or lesser extent. It's the eureka moment, right? It's that seventh act of an episode of House where he goes, now I know how to fix this person, and it's every procedural. That's the whole process, right? And I think that we're going to have a whole lot of those this year in 2023 for a whole lot of people, as we realize that the Fed put is dead. And too many people refuse to believe that the Fed put is dead. And because they refuse to believe the Fed put is dead, they keep saying that all these things are going to happen when none of those things are going to happen. So they believe that the Fed is creating a recession, which is then going to manifest itself later in the year, and yada yada yada, and that inflation has already been whipped, and it's all over it, except for the fat lady singing. And if the Fed keeps raising rates, they'll create a financial crisis. They said this in 2022, by the way. They said if the Fed even raises rates, they'll start a financial crisis. So frankly, a bunch of histrionic crap. Markets are far more resilient than that. There are far more liquidity in the system than people want to admit. The Fed has done an adequate job to this point of pulling liquidity out of the system in order to get people to finally go, yeah, but that's only because they had flooded the world with so much of it. Not just them. I'm talking about the governments around the world in response to COVID, that it was the only prudent thing for the central banks to do, the central bank of the world to do, was to pull back on US dollar liquidity. And so I've been one of the lone voices in the wilderness screaming that the Fed needs to go to 6-7%.
Hmm.
They're already at 4.5. They're going to go to 5. Everybody's out here this morning. We're recording this on Monday the 23rd. And we had two big headlines this morning. We had the latest version of the guy who's the Fed whisperer, Nick Timrial. So Timrial, I can't pronounce his name. I'm sorry. Over at the Wall Street Journal, telling everybody that the Fed is prepping the world for a 25 basis point hike because they're going to wait to see what the data looks like. Meanwhile, the ECB comes out and says we're going to raise rates by 50 basis points this meeting in February and that next meeting in March. And this was after 2 weeks ago, Christine Lagarde said that, well, we're going to stop raising interest rates soon. And then last week at Davos, she said inflation's out of control. And now they're going to raise by a full point over the first quarter of 2023. But I thought you were done raising rates, Christine. And I thought you were going to stop, QE, Christine. And I'm like, what are you doing, Christine? And yet everybody takes her at face value. But everybody else wants to, at the same time, everybody takes her at face value, but nobody takes Powell at face value by saying, we're not done yet. Because everybody wants to tell us what the Fed actually said, right? When the Fed clearly said X, and then, no, that's not actually what the Fed actually said. What the Fed actually said was Y. Well, look at the people who are telling you that the Fed actually said Y. They're all the people whose oxes are going to get gored to hell and back again by the Fed continuing to raise rates. So you think maybe I'm getting the vapors over here that these people may, oh my God, actually be talking their book like everybody else on Wall Street and K Street and at 10 Downing Street and on City of London and Hong Kong and everywhere else? Of course they are. So it's complete rotten nonsense that the ECB gets a free pass on everything they do. Like they're so wise and insouciant, and these are the people who kept interest rates at negative and were punishing everybody and destroyed the euro's chance at ever becoming a reserve currency in any way, manner, shape, or form. They've completely mismanaged everything about their society, and yet everything they say is taken at face value, but the Fed doesn't have any credibility with them, with these same people. Maybe, just maybe, the financial journalists don't know anything. Maybe, just maybe, the financial journalists all work for the ECB and the EU. And those people who just got their butts kicked at Davos last week. Because I don't know about you, but I saw a series of headlines last week that screamed one overarching theme. Davos is done. And that Wall Street's back in charge. And Wall Street, as I've been screaming about for the last 18, 20 months now, has no interest in the Great Reset. No interest in the retail central bank digital currency. No interest in having us not eat meat and drive electric cars and all the rest of this stuff, live in pods and all this other weird fourth transhumanist, fourth industrial revolution nonsense that Klaus von Kami-Schnitzel and the rest of these people all promulgate. And they all sat there and sniffed each other's farts about Davos for 4 days. While Jamie Dimon went there and said, oh, by the way, oil's going to be around for another 50 years. And the Fed's going well beyond 5%. But yet we're supposed to listen to some guy who's the new Fed whisperer? What? Because Lael Brainerd is sending him stuff? Brainerd isn't the Fed chair. Powell is. Powell's made it abundantly clear we're going much higher and for longer. So I fully expect 50 basis points in 2 weeks. If I'm wrong, I'm wrong. But if they do 25 this time, they'll have to make another 20. They'll have to do another 50 later in the year because in what I'm seeing is that inflation is already returning. That's my 30,000 foot view. So the Fed can't stop because de-dollarization on the one side and commodity inflation on the other side is going to force the Fed's hand regardless of what happens in 2 weeks.
Especially now with other banks, specifically the ECB, as you said, coming out and saying we're gonna do 50 basis points for the next two meetings and probably for the next couple of meetings. I guess a couple of his colleagues, the guy who said that in the media, they got mad at him for saying that. They said it was too early to say it and stuff like that. So it's going to be interesting.
Yeah, that makes perfect sense then. What it really means is that he was not supposed to say any of that because it's probably not true because he's trying to influence the markets. And if you look at the way LIBOR has been trading, and you look at the way credit spreads have been maintained, it's all been in the ECB's favor to try and destroy the Fed's credibility. I'm telling you, I will be honestly surprised on February 1st if the Fed only goes 25 basis points. I think the markets are going to be incredibly surprised if the Fed goes 50. And so I see a rate shock in 2 weeks. I see everybody all of a sudden waking up going, no, that's not possible. And then they have the big collapse, like, oh my God, the Fed's serious. And another tranche of the market will finally, get down with the fact that the Fed's not, it's not your daddy's Fed. It's not the Yellen Fed. It's not the Bernanke Fed. The Democrats, Pelosi's no longer in charge in Congress. The spending is going to stop. I'm not saying that they're not going to try and continue to spend on Capitol Hill in order to force the Fed's hand. But, right now, there's been a big rush into U.S. Treasuries. Fed's got all the room in the world to raise here.
What we've been seeing lately, though, is that the Fed's been letting, letting bonds mature off its balance sheet. Mm-hmm. That's what QT is, right? And I had two questions here when it comes down to them letting those mature off their balance sheets. Do you expect that to continue, QT, or do you think we're flipping into QE soon? And what does that mean in combination with interest rates?
You think that they're going to, I'm sorry, you broke up for just a second, so I missed the first part of the question. If you could repeat it, that would be great.
Whether you think they're going to keep letting bonds mature off their balance sheet, meaning whether you think they're going to keep doing QT?
I absolutely believe they're going to do QT, continue to shrink the balance sheet, and I absolutely think they're going to keep raising interest rates. Again, I think that I don't think they have any choice. I think the Fed has a tremendous amount of collateral out there, and I think they have a tremendous amount of liquidity. It's all parked on the sidelines. There's $2.5 trillion in the reverse repo market that can be dumped into the market if there's all of a sudden a domestic demand for dollars. What I've been saying about all of this is the following: the Fed is telling the world it does not want to be the global reserve currency anymore. Does not want to be the steward of the global reserve currency anymore. It is now focused on domestic politics. It's not trying to save the world from climate change. It's not trying to save the Europeans from their own feckless, overspending and reckless entitlement system and education system and everything else that they built on the back of cheap Dutch oil and gas and cheap North Slope oil and all the rest of it. It's all gone. They used it all. They used up all their seed corn, and now and they've lost access to cheap Ukrainian coal because they refuse to make nice with the Russians. This is their problem. It's not our problem here in the U.S. And what the Fed is literally saying is, we don't need to be just another purveyor of euro dollars like everybody else. It's interesting. We were thinking about this, and I was chatting with my partner Dexter White about this last week, where we were putting the finishing touches on this month's Gold, Guts, and Guns newsletter. And one of the things he said to me, he said, it's really funny. Everybody acts as if the Fed's two powers to print money and to remove money from the system are symmetrical. Right, that they have symmetric power within the marketplace. They really don't. In a global reserve currency situation, per Jeff Snyder's arguments about the Eurodollar system, when the Fed's printing money, they're just another creator of Eurodollars because they print. They facilitate the Congress deficit spending. They allow a whole bunch of dollars to be and a whole lot of treasuries to be bought up, sent overseas. We buy a bunch of cheap Chinese goods on the backside and liquefy the military industrial complex. And then the dollars go out. They liquefy the global banking system. They get levered up 10, 20, 40, 50, 145 to 1. And that's the Fed's just like everybody else. Just another purveyor of Eurodollars at the end of the day. Really. But what the Fed's real power is the ability to take that base money away. Because, and in the early stages of the Fed taking some of that base money away, there's enough liquidity sloshing around that people don't believe it. Because they can look at all the gross aggregate numbers and they go, oh, I don't believe the Fed's doing anything. And now the Fed's always pivoted in the past. And everybody talks the book. But the real power that the Fed has here, unlike any other entity in the world, if they really, as a singular actor, not as a conglomerate actor, like all the European banks are going to conspire together and stop lending in Eurodollars. What are you kidding me? That's their superpower. That's their secret power. The Fed's real power is to say, yep, you know what? We're pulling $5 trillion off the market. And no one else has that power. And everybody whose life depends on the Fed providing an ever increasing supply of fake dollars with zero risk associated with them, right? At the zero bound, where R star equals zero, or supposedly equals zero, even though R star has never equaled zero. All of a sudden, that's when everybody starts complaining. And that's what the Fed put is. And that's what we've conditioned people to believe is real. And in Keynesian terms, and in Krugman-like terms, and in whoever else you want to talk to, Larry Summers or anybody else, that's responsible statecraft terms. Nonsense. It's completely irresponsible. It destroys savers and emboldens debtors. And guess who the debtors are? They're the guys that are out there starting wars and overthrowing governments and planning our future to eat bugs and live in pods. And so, of course, their collective oxen are all being gored, and they're not happy about it. And so, since they control most of the media, they write all these stories, and a whole bunch of unsavvy bond traders and hedge fund managers and family office owners and head leaders of family offices and fund managers and everybody else who have been living a lie for the last 50 years of the bull market in U.S. Treasuries of ever declining risk. These are all also cantillionaires of a certain lower strata who then believe that the Fed will always come to our rescue. The dollar is still the only real punk rock out there, and that's just the way it's going to be. And what if all those assumptions are wrong? And what if you've been living a lie for at least the last 15 years since the Lehman Brothers, and you just didn't know it? And so you have the Davos morons who, woke up, who were born on third base, thought they hit a triple. You got a whole bunch of freaking unsavvy bond traders who who were born on second base and thought they hit doubles. And you've got a whole bunch of other guys who have been, hedgies and, momentum traders and financial analysts who, financial bloggers who have always been able to just, wake up from when Ron Paul uttered the magic words "end the Fed" and thought that, that's what we have to do to bring the world back to reality. None of that is true. None of that is true at all. At all. None of it. They could all be undone with a Fed funds rate at 7% for any length of time. And we can really see what the markets look like between now and then. And the Fed, because they have been smart about basically banking all the money that they were forced to print during the CARES Act, and then the Treasury released onto the world, they soaked up a couple of, $2.5 trillion of it to sit as real reserves of the banking system while everybody else goes broke, and they can liquefy the domestic banking system when they start to go broke. And, there's some spillover effect. Well, they're all catching tuberculosis over here. We're getting a cold. I'm like, okay, well, a cold. You guys have got terminal tuberculosis. What else are you going to do? So have fun. And every once in a while, and anybody who is a friend of Jay will get bailed out. And everybody who's not a friend of Jay will not get bailed out. That's why Credit Suisse got bailed out when Davos went after them right after they took over the Bank of England. And the Bank of England, I'm sure, has been the one buying U.S. Treasuries in order to try and drive the 210 spread down and try and keep the credit spreads between U.S. and Eurozone debt within a tradable range where there's no spasm. Why do you think they went after the BOE the way they did? Why do you think they created the coup against Liz Truss the way they did? I think it's very clear. But again, you have to once you see the world from this perspective, then you can start to then I don't sound like a lunatic. But this lunatic's been right about every bit of this shit for the last 18 months. So I'm not right about everything, but about this I've been right all the way down the line. And every once in a while I will, pat myself on the back for it, but not because I'm interested in feathering my own ego or, just getting more subscribers. It has nothing to do with that. It has about getting the truth out there so that people are better armed with better information so they don't make terrible, terrible mistakes listening to guys like, I don't know, God forbid anybody ever listened to Paul Krugman, but even to listen to most of the guys within the gold community, because there's a whole lot of people out there LARPing as good Austrian economists who have been giving you bad advice for the last, God knows, 10 years now. So
it's true. Basically, the guys who went long TLT last year, I was so certain of it. It was kind of funny to watch because I think you knew what was going to happen. You were talking about that too.
Right.
I want to go back to the Fed pulling liquidity out of the system, because what Governor Waller has suggested here recently is that the reverse repo balances become interchangeable with bank reserves. So basically setting up the system so that QT can continue for another 3 or so years, I think is what Joseph Wong suggested, while in the same time cutting interest rates. So pulling liquidity out of the banking system, out of the financial economy, but putting money into the real economy. Is that a fairy tale?
I don't have a problem, and I haven't thought that far ahead, to be honest with you. It's a perfectly valid way of looking at it. I think that we have I think that's too far ahead. I think that's like step 5 or 6 or 7. And step 2 is, how do we bankrupt the ECB? I've been on this point for a while now. Like, that's the one that the Fed has to deal with, because the ECB is their biggest direct competitor. And they're the one, and the ECB is the one that exists wholly because of the previous Fed's desire to be just another, purveyor of Euro trash dollars. And I think that once that's taken care of, once everybody understands that, no, really, the ECB has got no skin in this game at this point. And always watch the Bank of Japan, because they always act as the Fed's wingman. When the Fed wants a weaker dollar, then the Bank of Japan will strengthen the yen, and vice versa. So, everybody looks at Japan. Oh, is Japan going to collapse? Japan is just the Fed's wingman. Like, that's who they are. And they've always been that, and they always will be that until such time as the Bank of Japan collapses. But I don't think that's going to happen. I don't think Japan's in that position, but I may be wrong about that. Happy to be challenged on that. But as far as a way to recapitalize the RRP facility being cash necessary to recapitalize the real economy, sure. But we first have to have a banking system that has proper risk assessment associated with it, so that the banks can then go out and start actually issuing domestic loans that bear some resemblance to the real risk that's out there. Then we have to keep those balances tight and tightly held. So keep raising rates, keep making U.S. debt more attractive, and raise Treasury debt to be attractive. And then, when it gets to a point where it's restrictive, well, guess what? At some point, SOFR will tell us that the Fed has gone too far, because that's where the demand for money is going to show up within our domestic banking system. And we'll find out what, mortgage rates look like, and auto loans look like, and all the rest of it. And everybody will, start to really sharpen their pencils. And the MBAs who are working for all these companies will actually go back to doing what they were trained to do, which is assess risk, and stop, trying to figure out how they can, run discriminatory pricing models on your cell phone bill, and how to get you into a $75,000 truck that you don't need. Because that's what the MBAs have been doing for the last 15 years, because they haven't been able to do what they were actually trained for. So how about we get them back to doing what they were actually trained to do? What's the actual internal rate of return on that friggin' bridge we need between town A and town B? No one knows. We've just, done the Keynesian thing, dropped interest rates to 0, and built a bridge. It's dumb. I can't hear you.
Oh, I must have muted my mic. Sure. I was asking you if that's what happened last year, though, and when we had this credit expansion, there's like $1.5 trillion or something. There's like 3 times more the usual credit expansion.
Yeah. I think I don't mean to cut you off. If you had something else to say, please go ahead and finish the point.
No,
all I was going to say is that I actually addressed this in this month's newsletter. It's funny that happened. I think a lot of people saw the Fed was raising interest rates aggressively and went, I want to lock in a mortgage or a car loan or whatever at a fixed rate below the market, and therefore if I can get a car loan now. Hell, I even did this. I did this. I swapped from one used car to another used car that was, recently, and I was still, and because of my credit, I was able to get basically the same percentage rate I was able to get a year and a half ago, right? I'm like, cool. Like everybody else is getting 10, and I'm at, not 10, right? A lot less than 10, and my credit rating is mostly a function of the fact that I'm going to be 55. It's not because I'm so insouciant and wise or anything. I don't want to, again, I don't want, it's just that's how credit ratings work for the most part. And like, great. And I saw that. I'm like, yeah, I'm going to do that. Like, I bought some very, very cheap fixed rate debt. Not a lot, just a little bit, keep cash flow very high relative to your debt level, and, and manage your personal balance sheet that way. But at the same time, I know that I'm getting an interest rate differential. I remember I've told this story before, but I'll tell it again. When Volcker did this back in the early 80s, and my dad was about to retire from the NYPD, and he was going to get a chunk of money along with his pension. He was going to get a payout that year along with an increase to his pension because he had done a lot of overtime in his last year. And the way it worked out, it was very generous to you in your last year of service. And he said to me, we were standing he was smoking a Kent, like my dad was, like Pat was, want to do. My dad smoked Kents. He's so Brooklyn, it wasn't funny. And we're standing there on our driveway in the house I grew up in upstate New York. And he said to me, Thomas, what do you think? I got this bunch of money coming in. Should I pay off the house? Or should I, should I leave the money? Or what should I do with it? Or, should I pay off debt, or should I invest it? And I, of course, even then, not knowing a thing about money, I said, well, Dad, pay off the debt. Own the house. It's yours, and you don't have to worry about it anymore. He's like, yeah, but I've only got a 3% mortgage. Moreover, he only had a 3% mortgage on a house he paid $28,000 for the year I was born in 1968. And that house at that point was already worth over $100,000. And he had what? 15 years left on a 30-year note at 3%. Like, what do you owe? 17, 18 grand. Right? If you took that money, and he was like, well, Thomas, if I do that, I can get 13% in the money markets. So he was netting 10. What's the same thing that people did last year? They bought car loans at 3 and 4 and 5%, new car loans at 0, 1, 2, 4%, knowing full well that in 2 years, new car loans are going to be 7. And they're making 5%. They're making a 5% big on that. Anywhere from 3 to 5% big on that. Why wouldn't they? Let the car company deal with that, especially if they could drive a good price on the car, as long as they didn't pay 5 or 7% more on the price of the car, But that's what they were thinking, and I'm sure many of them overpaid. And they're going to wind up with some ugly loan to value ratios once the used car market starts to drop, but. They can handle the monthly payment. That's why they did it. Whether it's going to work out for them or not is a different story. It worked out for my dad. So, but his was such an extreme situation with such a small amount of debt that relative to the situation that it worked out. So,
seen those videos though. Someone would go around the office asking people, how much is your car payment? And people go like, oh, it's $1,500. And then somebody else goes like, oh, I have 2 car payments, like $1,700 and $1,900. And like, it absolutely blows my mind as a European. I mean, I don't know how things are over there, but this just seems too much.
Yeah, it does. The average car payment now in the United States is $800.
Still high.
It's incredible. And the average loan length is over 6 years now. So I think it's close to 7, which is also incredible.
On a car?
Insane. On a car.
Wow. And especially if people are buying electric cars on those type of loans, in 7 years, that thing is going to be worthless.
Yes. Literally, you're going to have paid 5% on a car that will depreciate close to 0 over 7 years. Yep. No, I mean, the used car market here in the United States, because of COVID and the cock up of the supply chains, used car prices are still out of control. They still need to come down 30. Used car prices in the United States could come down 35%. And they would still be and the cars would still be overvalued. So don't get lost in the headlines about, used car prices in the US are cratering. It means a recession. But no, it means that 8-year-old cars in the United States were trading for the same price that they were paid for when they were new, because the market was all screwed up. It doesn't mean that, and so once you do that and you take an 8-year-old car should have been depreciated by 60% by that point. 60, 65% at least. And that's if it was well taken care of, right? Cars are supposed to depreciate 50% over the first 5 years. Only like Jeep Wranglers and like a very few model cars depreciate less than 50% over the first 5 years of their life. Jeep Wranglers happen to be one of them. So I don't know what the other ones are. I'm sure it's like Toyota Tacomas and a couple of others that are just, people are just insane about here in the United States over buying old Tacomas. I don't understand it personally, but whatever. I mean, I like Tacomas, but I think they're overpriced, both new and used. So I don't get it, but that's reality, and we're not even close to that right now. I mean, it's off the charts how weird the price of used cars is, but that will come down. It'll come down over the course of 2023. We're gonna have a recession in 2024, but just not in 2023. That's what I think. I think everybody's starting to come around to that thinking much quicker, actually, I would say, than I was expecting. I was expecting there's going to be a terrible recession this, second half of this year, that was going to die hard. It was going to take until March. It's already starting to turn because people can see the oil loading numbers coming out of Chinese oil traders going, oh yeah, no, this is coming back quick once Omicron 2.0 is done ravaging China.
Well, if you think it's going to be 2024, that does leave time for the Fed to raise interest rates above 6% and then have plenty of room to cut them in 2024. Is that when you expect them to start cutting?
Yeah, they may not cut immediately, but they'll probably. I'm on record as saying I think the Fed goes 4 50s, so they've already done one, and then they'll do 3 more 50s, and then they'll do 4 25s. So there's 8 Fed meetings in a year, and the next 7 will be rate hikes, in my mind. And that'll bring us to a terminal rate, gradually bring us up, nice and asymptotic slope, right up to 7%, and then stop. And then they can assess where they are. Okay. And maybe they'll, the roadmap won't be as smooth. Okay. But I think that's the most likely scenario still. They get to 7 and they'll hold it for a couple of meetings and see what they need to do. Now, do you think between now and then that these crazed vandals over in Europe won't try to sabotage the Fed's plan? Do you think they're not trying to sabotage the Fed's plan right now? They already tried. They already did once. They took over the Bank of England, and they tried to bomb Credit Suisse out of existence, forcing the Fed to open up dollar swap lines with the Swiss National Bank, who then bailed out Credit Suisse. And then the Saudis came in and shored up Credit Suisse's balance sheet. Funny how that worked out. Who then just went to Davos last week and said, yeah, we're thinking about, opening up our trade to currencies other than the dollar. Right.
But until then, strong dollar, no place for commodities to run then.
Oh, no, commodities are going to run. And I didn't say it would be a strong dollar. What we have now is we had a nice pullback in the dollar index. Remember, the dollar index is not, I'm not talking the trade weighted dollar index. I'm talking about the dollar index, which is mostly the euro, the yen, and the pound, right? There's no Chinese yuan in there. And the Chinese yuan has gone, and if you want to talk about what's really pushed the dollar down, it's the yuan has come back from 7.1 back to 6.75. Right? So, but oil is just broke out above $87. It's going back to 100. Copper broke out above $4. It's going up. It's going back to its all-time high above 5. Aluminum's back to $2.55 or so a pound, or at least it was last week. I didn't look at it this morning. Nickel's back towards $9 a pound, or you can go through the entire industrial metals. And why I'm adamant that there's going to be a return of inflation before anybody gets it is because the industrial metal sector is telling you that there's going to be cost push inflation from a base commodities perspective in the second half of the year, if not before the end of Q2. So even if the Fed does go 25 basis points in February and everybody gets to tell me that I was wrong, I'll be like, okay, but is oil going to, but then they're going to ask me, I'm going to ask the follow-up question. Do you think the Fed's going to not raised by 50 basis points the minute the CPI starts to tick back up again because oil's back over $100 a barrel, and wheat's $9 a bushel, and aluminum's $3 a pound, and aluminum smelters are going broke and shutting down pots, and this is something people don't understand. And we covered this in the newsletter at the beginning of Q4. Aluminum's nickname is congealed electricity. It takes a lot of electricity to make aluminum metal. And aluminum smelting pots take an awfully long time to warm up. Yep. When they've gone cold, they take a long time to get back online. You can't just shut off an aluminum smelter and then say, oh, this week, and then turn it off, and then we'll turn it back on next week. You turned it off this week? What's your schedule for this time next year? Because that's when you're going back into production. So those things will be down for upwards of a year after they've been shut down. Aluminum production is not something you can just spin up at a moment's notice. So I need to caution people about this. It's not like copper smelters or it's a different thing. Aluminum is very, very, very electricity intensive industry, and people are not going to bring their aluminum pots back online just because the price ticked up a little bit. They're going to wait for a quarterly reversal signal. They're going to wait for a futures curve that's massively upward sloping before they ever start putting the pots back online. So don't kid yourself. When you see something like the French company, ArcelorMittal, and Alcoa, or any of the other big aluminum companies in the world, you see them say things like, we're cutting production. Aluminum's going up $3.50 a pound. And then you think that that's not going to translate into high baseline CPI? Well, I don't know. Maybe you should turn in your friggin', financial comment card, because you shouldn't be a part of the club, because that's just dumb. So same thing with copper's $4.25, guys. Oh, by the way, zinc's over $3 a pound. I can keep going here. It's just stupid. It's dumb. Of course it's going to start to tick higher. And, the Chinese are going to be buying oil like it's going out of style. The Russians are going to attenuate their production to maximize their revenue stream. So are the Saudis, and the Biden administration is still in control and Larry Fink's out there complaining about ESG investments. So, we haven't seen an uptick in investment here in the United States yet. Jamie Dimon wants us to do that. And so, yes, you're going to see reinvestment in proper risk assessed weighted investments, where the price of money in a scarce money environment is going to go to the things that are necessary, not this Keynesian nonsense of just let's get spending back up and then everything will take care of itself. Keynesians are obsessed with demand. They don't care about supply. And because of that, the things just get out of whack, and we get sincere amounts of malinvestment that stay on and on and on. But the massive layoffs that we're seeing from middle management and all these tech companies, what do you think that is? They're hiring they're hiring restockers and people to ship product around. And they're firing middle managers and, community managers and, all the rest of it. They have to, because those are make work jobs. Those are not shovel ready. Those are bullshit shovel ready.
Keynesians are obsessed with demand, not supplies. That's a good quote there. I think Keynesians are also obsessed with themselves and think they can control everything.
Yes,
but the way I'm getting this is it's true. The way I'm getting this is that you expect inflation to come back, but it's not going to be the effect of monetary or fiscal stimuli. It's going to be the effect of a tight money supply. So less money that has to combat for fewer goods as well, because there's going to be supply chain issues in the commodity sector. Am I getting it correctly?
Right. Yeah. No, it's cost push inflation. That is fewer dollars chasing the same amount of goods, if not smaller pile of goods. So a slightly smaller pile of goods with a much lower supply of money is what I think we're into. And it also means that you're going to get credit deflation in certain sectors where it belongs. Where there was too much credit in the past, there's going to be less credit. That's good. And and then I also think that once the reality sets in that the Fed is serious and that everything we thought we knew about how the economy was structured, we're also going to get that mixed with what I'm calling a loss of institutional confidence. There are three types of inflation. The Keynesians only ever want to talk about demand pull because it supports their thesis and it supports why government is necessary and why we all need to look to our betters like Nancy Pelosi, barf. And then there's cost push, which I just described. And then there's the loss, and then there's the one that happens at moments of realization of everything that we've been doing is wrong, that we've gone on the wrong vector or on the wrong path. And that's when people start realizing that those who have been the stewards of the economy don't know what they're doing. And that's an loss of institutional confidence. And that's when everybody moves into tangible assets. The last part of inflation, the last type of inflation is what ultimately fuels gold. And in a sense, that mix between cost push inflation and loss of institutional confidence inflation, because this is why the Fed has to raise interest rates. The Fed has to regain the market's confidence that that the Fed's not incompetent. And how do you do that? You raise interest rates. Okay. So if you take those two things together, I'm at the point now of calling that the goldflation trade. You've got inflation, you've got stagflation, you've got all of this. You mix all of this together and you got goldflation, because it's the one thing that will set gold higher in a secular bull market across the entire world, which is about what we're starting to see. Gold has just started to move into a secular bull market where it's now in a bull market against the dollar. That'll be confirmed once it hits an new all-time high. But we got a nice reversal signal in Q4 and a great start to Q1. Now, it's not going to be a straight up shot or anything. It's going to be very ugly as the world, reorganizes itself. There are a lot of people that are still hostile to gold. There's a lot of people who want to buy into gold but aren't allowed because their fund prospectus tells them they're not allowed, or their balance sheet requirements. This is all these rules out there that preclude people doing exactly what they need to do with their money. But what that means is you'll see them pull their money out of these funds, move their money into these funds, change asset managers, blah, 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 which is why BlackRock lost 16% of its AUM in Q4.
Okay. So it's basically going to be people have less money, which they would have to choose, where do I put this money? Do I buy an NFT or do I buy a loaf of bread? And so what you're going to see is deflation in stupid stuff, basically, and you're going to see inflation in food, shelter, and energy.
Right. So it's the same argument that I remember back in 2008 when Jim Poplava at the Financial Sense Network hosted a debate between Peter Schiff, inflationist, and Harry Dent, deflationist. And I'm sitting there listening to this. And I'm ensconced in my laboratory being a mad scientist, listening to all of this. And I'm going, you're both wrong. Harry Dent was arguing credit deflation is going to crush the economy and it's going to be mass deflation. Peter Schiff was saying, no, it's all going to be inflation because people are going to lose confidence. I'm like, no, you're both wrong. It's going to be commodity inflation and credit deflation. It's going to be stagflation. And then the central banks all coordinated policy, because the Fed was printing money. All the central banks were printing money. So Peter Schiff said inflation. Bernanke sterilized all the inflation. So the money didn't circulate. So how can you have inflation if the money's not going to move? You got falling money velocity. Harry Dent was right that we had falling money velocity and still do. Peter Schiff was right that we have an increase in the quantity of money, but he was wrong because the demand for money wasn't rising. So therefore, it wasn't rising. So, all of this stuff was just done. But what we did get was exactly what we expected. We got credit deflation, which caused the financial crisis. Commodity inflation, which sent oil to $150 a barrel. And then eventually the whole system collapsed and everybody got real. They all moved into gold when S&P downgraded the U.S. debt. And that's when we got the blow off top in gold from a gold bull market that had been simmering higher for years. We're at just the beginning of this. The gold bull market started back at the end of 2015. We're 7 years into it. Gold bottom at $1,000 an ounce. It's 1900 or 1920. And it's well on it. It's probably going to go to, I don't know, 7,000, 8,000. It's going to go somewhere much higher than where it is but it's only going to go until somebody puts their foot down and says, okay, you can have confidence in us, whoever that is. Right now, no one has confidence in anyone. And if they have confidence in anyone, steward of their money supply, maybe at this point it would be the Russians, but the Russians aren't allowed to accept our investment capital because of sanctions, so therefore can't go there. Because they're the only ones with low debt to GDP ratio, high gold reserves, yada, yada, yada. But no one's allowed to use the Russian ruble. So.
But many central banks have been increasing their gold holdings, and specifically banks that are sort of BRICS leaning, if you will.
Sure.
Do I follow the money and understand where the power is going to be? Is that type of thing?
No, absolutely. I think that you're pushing into the right direction, right? So the Chinese and the Russians are telling everybody it's time to buy gold. Central bank buying was like 15% of the physical gold market in 2022. And it was a similar number in 2021. I think it was like 12 to 13%, something like that. So we move into 2023, gold is going to simmer higher. And then it's going to explode once retail gets it through their head that they need to do something. And that's when the central banks are going to stop fighting the rise of gold and allow it to happen. Look, for years, the Chinese and the Russians have been accumulating, and you don't think that they've been helping the quote unquote bad boys over at the COMEX and the LBMA to help suppress the price of gold? What do you think? They're dumb? They want to buy gold. They don't want to pay top dollar for it. They're happy. They were looking at 1650 last year, going, like right. I mean, wouldn't you? If you're a contrarian investor, if you're looking to try and we don't want to talk about this, right? So, I mean, we all know that the Chinese have the PBOC has their traders out in the futures market all around the world through three deep nested subsidiaries and their guys on the floor, right? But of course they are. So but there's going to come a point where a rising gold price becomes a geopolitical weapon for them to maybe try and slow down or slow somebody's role in stopping a war, or I mean, there's all these angles to the picture. So you've got them on one side, you got retail and others looking at gold now going, what are these people doing? You got everybody else you got the other people who are still in the denial phase of the 5 stages of grief. They haven't reached bargaining yet, right? So they still believe that the Fed is going to pivot when they need, at the first sign of trouble. They're wrong, but and some of them are still at anger. It's funny. Like a lot of the Bitcoin maxis are still at anger. Like I'm like, guys, stop it. You're going to win eventually, but just not this cycle. It's not your time yet. That's what, so this is my general view of the world, Antonio. And I just think that it's, again, we go back to this idea of, when are you going to finally give up and lose your religion on this thing or that thing or that thing? And as we go through each of these moments in time, these little mini inflection points, these twists and turns, more people fall out of the former camp into the new camp. They change their investing habits. They look at their portfolio and they go, oh, I'm way misallocated here. And then they start to shift their allocations. And if it's big money has to shift money without moving price. So it takes a long time for that to happen. Like when you got $5,000 to invest, you can do whatever you want. Most markets can absorb that unless you're dealing in penny stocks. But then again, if you've ever owned a penny stock, you know how hard it is to move $5,000 of a penny stock. You know how hard it is to accumulate that without moving the price, because you're the market. Well, when you got $1 billion to move, you're the market, and your market isn't the Dow Jones Index Fund, right? It's not DIA, the Dow Jones ETF, or whatever.
And you can rug
You
pull
want,
yourself.
mm-hmm.
Because there's this old broker story that a broker would call up a man and they would tell him, oh, there's this penny stock, you should buy it. And they would start buying it. They'd buy 10,000 and then the penny stock is going to go up 10%. They're going to say, oh, let's put more. Then it's going to go up more. And then eventually it's up 200%. And, smart speculator says, okay, I want to take out my money. I want to sell this stock. And the broker says, to who? You're the only buyer.
You're the only buyer.
Yeah.
Right. What are you going to do? So who's and this is what happens at Bitcoin at 68,000. This is what happens at, and this is why, I go back to one of my mentors, Jim Sinclair. The first rule of the market: sell a rhino horn, buy a fish hook, right? So when a market is going down exponentially exponentially to the downside, you should be buying. I don't know if you catch a falling knife or whatever. You wait for the bottom to confirm itself, and then you're comfortable. Then you can come in and buy. Leave the bottom to the guys who are manipulating the market in that direction. Same thing on the way up. When the market starts getting frothy, sell. Doesn't matter if you sold at 100 and it goes to 120, because in 2 weeks it's going to go back to 90. And you'll never have gotten to 120 anyway, because you weren't a market maker. You weren't some privileged guy on Wall Street. You're not going to get that. You're not going to get that. You're not going to top tick the market. Like, they'll trade, even if you put in a limit order, they'll trade around your ass. I've been there, or I pulled and watched them trade around me, and then settle me out $5 below that. And I'm like, there's nothing I can do about it. What am I going to do with my $500 trade? They wouldn't even give me that. And once you see that, you're like, yeah, forget it. I'm just not even playing this game anymore. But this is why I don't trade anymore. It's why I don't. But when people ask me what to do, it's the same rule over and over and over again. You leave 20% at the top and the bottom for the God of greed, and you try and catch the middle 60% of the move. And if you do that more often than you miss, you're going to do really, really well. You're going to be the next Jeff. If you can do that consistently, you're the next Jesse Livermore. Like, seriously, because that's all he did. So, I mean, what you want to be is pre-positioned ahead of time by looking at the entirety of the landscape. So why do geopolitics and markets together? You want to be pre-positioned to see what's on the horizon, and then also see where everybody else is misperceiving, and then realize that their misperception is going to last an awfully long time. And then just watch for the smart technical signals that will tell you what the breakout is, and then stop buying, and then wait, and then sell on your way up in tranches, make your money, get out while the market is liquid, and and then sit back and count your money.
Yeah,
right.
I can do that. That I can do. And then geopolitics and macro, they go together. Absolutely agree with that. I would not have agreed a year ago, and then I saw what happened to my portfolio for ignoring both of those, and then towards the end, sort of getting into macro, but still ignoring geopolitics. And it's just those two go together, and they're just important. It was proven to me by my portfolio last year. So
it was proven to me in my first year as a newsletter writer for Newsmax, and I was having to advise, and I was advising people, and my portfolio got its ass kicked multiple times. The newsletter writing business is very, very difficult. And I'm not saying that I do a great job or I don't do a great job. It's very, very difficult, because you're usually writing at least a month ahead of time. And then your ideas have to be stale. It's like, and like, you're trying to, project out 3 months into the future what the stock's going to look like, and then where to position yourself, and how to tell people the right story at the right time. But at the same time, you also have to teach them how to fish, so that they can identify these moments for themselves. And once they identify them for themselves, then they don't necessarily, then they just use you as confirmatory of what they're already seeing. And there's still value there. And as long as you're not charging them, a ridiculous amount of money for that service, then you can usually drive a fair amount of value to them. And that's the business model, and that's where I'm most comfortable doing this, where if you can always drive more value for people than you're quote unquote extracting from them for your time, for your time, and you can do so in the aggregate with a lot of people, well, then everybody's going to be happy with it. And then that affords you the time to then serve them by spending all your time serving them, right? And that's the model. And it should be a good feedback effect. So,
Yeah, basically make money net of fees. Tom, is this a weird period in the markets? Like you've been in the market, you've paid close attention to these things for a long time. Is this, especially frothy markets? Is this especially weird to you?
Well, the equity market's not especially frothy. I think the equity markets are just choppy. Maybe the European markets are beginning to get frothy, as everybody's like trying to figure out where to put their money. Again, we're seeing that flight to quality, their flight to tangible assets, and it's just showing up everywhere, right? And I put long dated U.S. Treasuries in that pile, even though they're ephemeral debt instruments, right? Because they're still thought of as a hard asset. Same thing with German bonds to a lesser extent, right? So there's certain types of debt out there. Apple corporate bonds absolutely have to be thought of as a high quality tangible asset at this point, right? I'm not sure that they're not overpriced. I haven't looked at the price on them, and I don't really care because it's not something I would even think about recommending to people. I don't truck in the corporate paper space at all, right? But it is a weird time in the markets because we are living through a time when the global macro picture and the geopolitical picture is changing, and there is a changing of the guard happening, and the old rules that we've always grown up with don't really apply. We're in a bear market for U.S. Treasury bonds, and we will be for a while. Will it be a bear market every year? No. Was it a bull market every year during the bull market? Clearly not. But we had the big breakout in rates in 2022. It's going to continue. This is a reaction rally in Treasury bonds. It's going to end as everybody goes, oh, well, Treasuries are expensive. Too many people will be trapped on the wrong side of the trade and thinking that the Fed's going to pivot and again, they may not pivot here in February. They may pivot again in March. They have to go back to 50 in March. But once that happens, forget it. Like it's over and done with. But Daniel DiMartino Booth keeps banging the point home that Powell was told by his staff all during 2021 that inflation was transitory. And he went out there armed with that information, and they made him look stupid with that. And they made him look ridiculous. And he's angry about it. And I don't think and in her mind, he ain't listening to them anymore. And as the Fed chair, he ultimately makes the decision about interest rates, not some guy writing for the Wall Street Journal. That's what everybody has to remember. Sometimes you have to assess not just the policy, the big trends and everything else, but you also have to look at the men and women who are making the decisions and the quality of those people. One of the things about investing that people forget about all the time is that management matters. The product is one thing. The stock price, the financial gearing, the this, that, all that stuff is important. You can look at a balance sheet. You can look at a cash flow statement. You can look at an income statement. You can, apply all the, MBA stuff you want. But if the CEO sucks, company's not going to be successful. Company may be making money right now because there's such a mismatch and mispricing and such an arbitrage opportunity in the market that this company couldn't help but make money, even if they had the worst CEO in the history of man. Even if Steve Ballmer was brought back out and put at the head of whatever company you think is going to, make a 20 bagger. That guy's the worst CEO in the history of man. He's lost more shareholder value than any other CEO in history. And if you think that there's some gold miner out there that's trading, a 500 bagger, I got news for you. Ballmer will be able to figure out how to turn it into a 50 bagger. Okay? But it'll still be a 50 bagger. And it'll still make him look brilliant. I love ragging on Ballmer because he's such a pig. But just think of it that way. Now, look at your political situation and apply that to your countries. And why do you think people are worried about what's going on with the United States. We've got a guy out there licking the friggin' drapes, for Christ's sake, as president.
Well, what country do you think has a good management? What country has a good leader? Do the Saudis have a good leadership? Well, who's got the good leadership?
I think the Saudis have proven themselves. I mean, I think MBS is a ruthless, mass murderer and a warmonger, but is he doing the right thing for Saudi Arabia right now? Yeah. I mean, is it an authoritarian regime? By every definition that the UN says it's an authoritarian regime, but somehow Putin is that guy. The Eurozone clearly has bad management. There are, and then there are countries out there that have perfectly good management, but are in situations where they can't express themselves. The best they can do is just try and hold off the massive sustained assault on their sovereignty. Viktor Orban in Hungary, for example. Vladimir Putin in Russia, for example. That forces them to deal with that stuff rather than build their country. Because Orban is stuck within the confines of the EU. Putin is Putin. So when you think of it in those terms, it's really, really difficult. Is Erdogan a good leader of Turkey? From one perspective, absolutely. From the Turkish leader's perspective, no. It all depends on, and then you have to assess within each of these people of their priorities or of your priorities as an investor or your read on geopolitics, from what vector are they competent? Do a SWOT analysis, for example, on Erdogan, right? An SWOT analysis on Erdogan, and then put all the things out there and go, okay, so Turkey, make good, bad, indifferent, depends on your perspective, and this is much, but the people are important. Personnel is policy. And right now, until Biden is removed from office and we see what the fallout, and he's going to be removed from office, we see what the fallout from that looks like and how the shape of that fight plays itself out over the course of 2023. And again, that's going to funnel into dollar weakness, because the headline is going to be there's a fight at the top for the U.S. political system. And while that's going on, will that affect the dollar? Yes. Will it affect U.S. equity markets? Yes. Will it freeze capital in Europe? Yes. Where it doesn't belong. But at the same time, if you read between the lines of the domestic policy headlines in the United States, you might come to the conclusion that the right guys are winning and we're actually getting rid of the usurpers. I don't know that that's going to happen. That's my hope. And if that does occur, you're going to see very subtle capital shifts in the marketplace that will give you clues to that. And I'll be looking for those things. I don't know what they are right now, but I know that I'll be looking for them. And when I see them, I'll know them. You know what I mean? Because I'm going to trust that I've done the work, that when something happens, I'm like, that's it right there. And I'll know. And then I'll watch the markets react to it in real time. And then I'll know that that's the new vector. That's the new thing I should be looking at. This is how I do all of this, what I do. It is really kind of instinctual. It's not, it's not quantitative by any stretch of the imagination. Because politics isn't quantitative, because politics is absolutely qualitative. We're working with inferior information at every level, even though it's an information war in an information age. So then, you know what I mean? So it's, I don't always have hard and fast answers for some of these things. I just know that these are the things that I'm looking for. I've curated a community that feels the exact same way, so they're helping me keep my hand in it. And we as I hate to put it, but we as a kind of hive mind, and the people that I read and the people that I interview and the people that I hang out with, eventually you get to a state of maybe being slightly more aware of what's going on than other people are. And then that hopefully will give you the uncommon insight and can drive some value to people as best as possible. That's what we're doing. But we're all shooting in the dark, dude. Every one of us.
Would moving to a gold-backed currency or some kind of a commodity-backed currency be that switch, or is that too obvious for you?
It's way too big. And that's what they're not. No way are the BRICS countries going to do that anytime soon.
Why not?
Because it's too disruptive. They're not ready for it. They're not ready for the capital inflows. Gold price isn't high enough. So, but they can lay the foundations for it, right?
What does gold have to be for that to work if it's not high enough? Like,
I
what do
don't
you
know.
mean? I don't think I
I don't
get
know
that.
what the number is at this point. I wish I knew, but I don't know because I haven't watched enough of this play out yet to know is the problem. You know, it's like everything else. We think we know what those numbers are. We think, you know, again, there are too many moving parts. There are too many differential equations to solve simultaneously, right? We're not trying to solve 2 or 3 differential equations at the same time. We're trying to solve 40 and get a number. You get a function. No. You know, I remember just enough about my upper order math to know that I don't have that there are too many variables. So what you do as best as possible is trying to, and this is, again, goes back to my scientific training, where you just say, okay, I'm just, in effect, every day I get up and I kind of design an experiment, with a hypothesis about the markets. And I go, well, what are the variables? What are the 5 major variables for this particular thing? This, and this. What about these other 15 variables? They don't matter. Knowing the difference, and they don't matter because they're not a huge effect. They're a secondary or tertiary or quaternary effect. It's the primary drivers of those things. And then every once in a while, you're like, oh, well, I was wrong about this one. That one's not really important. So let's substitute a new one. But if you can get most of them right, then you're going to probably be in the right ballpark. But every problem or every hypothesis has a different set of variables. Now, what's interesting is when you start setting up multiple hypotheses and you start seeing the same variables, that's when you know you're onto something. Because now you can make a bigger hypothesis that covers all the littler ones, right? So could the Fed be at odds with the rest of the central banks? Yes. Blah, 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 blah. Could that mean this? What would that have to look like within the U.S. political space? What would the reaction to that be? Well, it would look like this. Well, what about this? And then you just keep testing those things and then asking those questions, and then and try and be as dispassionate about it as possible, and then move on, and then do your best. And
tell me more about the BRICS and the Saudis, though. That seems like a very interesting part of the world that is like, it always seems like it's either Western media has taught me to think about it that way, which is a very good probability, but it seems like they're like cooking something, I don't know how to describe it. Like, it's
they are cooking something, and they are definitely cooking I think they are cooking some kind of commodity backed regional currency. And but the Saudis definitely no longer need the dollar as the only thing to peg their currency, their real to. It's hurt them a lot and helped them a lot over the years. They've always tried, with their relationship with the U.S., to be ahead of the curve and gain market share. But now they're and with each pump and dump of the price of oil over the last 40 years. Problem for the Saudis is that they can't pump any more oil. They don't have any more capacity to take market share. So there's nothing the United States can offer them to maintain market share because they don't have any more production to bring online. So, and this is why I say, MBS may be a ruthless mass murderer and everything else, but he understands that the Saudis, as nothing but a petrostate, is over. And they have to diversify the economy. They have to bring this country out of second world status. And their best ally in doing that is the other major oil producer in the world, Russia. And so the Russians have been very patient with the Saudis in building OPEC Plus and building a good, strong relationship with these countries and giving them opportunities now to diversify. There's still plenty of oil and natural gas out there. It's very clear that the Europeans are the ones who are most hostile to oil and gas because they don't produce any. And so therefore, they want something else. And but they still think that they can colonize and recolonize all of these, former colonies and keep them on the hook. And that ain't true anymore. And so, as this moves forward, they're in trouble. The United States and the plutocrats. See, it's a funny thing. It's like the United States is a plutocracy no less than Europe is, right? But what if we have globalist plutocrats and sovereigntist plutocrats? This is the best way to put it for people who think I'm out of my mind. Why would you believe that all of the plutocrats in the United States are nothing but satanic globalists who, like, drink adrenochrome and, all the rest of it? Why do you believe that? Who told you that? It's a good question, and you should probably ask that question. As opposed to believing that there's, like everything else, there's some of them who actually still believe in the United States, but they also like making money along the way. Don't you think that there's some sovereigntist plutocrats out there? Yeah, we have to deal with them. They're plutocrats. They're terrible. They think they have the right to run everything. Well, at least they have the right to run the United States, but they don't. But we don't have to disabuse them of that notion until after they've helped us get rid of the globalist plutocrats who are absolutely trying to destroy the United States.
Right. How's that different from communism and what happened to the Soviet bloc?
It's not really that much different. So we're at a very dangerous moment in time. But then again, so are the Europeans. And the Europeans have lost all their dynamism. And the world doesn't want to put their money into the EU. The EU's already told everybody for the last 15 years, don't put your money here. Or we'll tax it away from you, or we'll destroy it. We'll destroy your value. The deposit rate was negative 0.6% for how long? You put your money in a European bank, they're just going to steal it from you.
Mm-hmm.
You can't it's like, no. Like, and the Chinese have very, very craftily just said, look, we're going to manage things for ourselves. And you guys thought that because you put all your money into China means that you're going to get it back out of China without cutting us in, and then take us over and not give us a seat at the table. And Xi's like, yeah, that's nice. That was cute. Sorry, Soros. You have no political power here. Your money's stuck in Evergrande or wherever Soros put billions of dollars into China that Xi just blocked. Yeah, that's why Soros is so pissed. This is good. We got him on tilt. I mean, if you're a poker player right now, if you're China and you're a poker player and you're looking at the geopolitical table, this one just popped into my head. How do you win at poker? You win by getting the guy to bet wrong consistently. Eventually, he'll bet against his own pot odds. He'll bet wrong, and you'll take all his money. He can win 7 pots in a row that he should have never been involved in. But you got him on tilt, you got him betting wrong, and you just wait. And then that 8th pot, he thinks he's got you. And on the 8th pot, you're like, yeah, but I'm pushing all in, dude. And you're like, he's bluffing. Fine. Now you take all his money, and he's gone. That's what happened to Soros with Evergrande, I think, or any attended knock-on effect of Evergrande. I don't think Soros is the only one. But I also think that, like, JP Morgan, I think they got the money out first. And there was a headline this morning that actually confirms this. I have to go look for it, but there was a headline this morning about JP Morgan and Chinese investment this morning that was kind of confirmatory of that idea. Again, just reading tea leaves here, just putting stuff out there. It may mean something different, but I think I'm right about that one too.
JP Morgan Asset Management expands in China.
Yeah. I think that was the one this morning. Yeah.
Yeah. And now significant steps in advancing its long-standing commitment to expanding in China. And they have received regulatory approval from China Security, from the CSRC, to complete its acquisition of China International Fund Management.
That's it. That was the one this morning. Fascinating little tidbit this morning. As Luke Roman would put it, fascinating little signpost, don't you think?
So the China International Fund Management will be operating under the JP Morgan Asset Management brand in China. Okay.
With 100% ownership.
Yeah. Hmm. What does that? What does that? What does that mean?
It just
I
means
mean,
that I've been arguing from the beginning that J.P. Morgan is the one leading the charge against the Euro trash commies.
so it's
And
still
so,
about the dollar.
it's a little quid pro quo from China to J.P. Morgan for, you know, backing the right play for the Chinese in the long run. I think everybody has lined up against Davos and the European Union and just getting ready to pull the plug on all of it. I just do. The signs are all there, and I, you know, I've been watching these people for an awfully long time. I think it's a Shark Tank. I think they smell blood in the water. I think they smell blood in the water about BlackRock. I think they smell blood in Europe, and the European leaders are all now screaming, and they don't have any options. They're out of options. Now we got Macron out there, saying that he needs to dealing with strikes all around France because he has to reform the French pension system.
Hmm.
Like, you put it off to this late date. You should have been doing this when you first took office. And the reason he's having to do it now is because there are no euro dollars. And it's another signpost that I think that the Fed is winning. And again, why would the Fed, if they're winning, why would they take their foot off of the neck of the ECB and Europe if that was their ultimate goal, which was to bring the dollar back to be a more domestically focused currency that they have better control over. Doesn't make any, and then in the process recapitalize the United States. Many ways that the United States
can be though, right? I mean, the dollar's got to be strong. I mean, it has to remain at these elevated levels, as they call them, for that to work out.
Yeah, against other currencies. It's against. Remember, this is all against fiat currencies. They don't matter. Gold is going to rise, but it's going to be on the Fed's terms, not on the ECB's terms. Okay. I think the Fed's going to wind up putting Bitcoin on their balance sheet in the end. I think they're going to, I think all of that's going to happen, but it's going to be on the Fed's time schedule, on the Fed's on Wall Street's schedule, not on Euroclears, for lack of a better term. This is what I think, and it's hard for me to see it any other way at this point because it just keeps getting proven to me over and over and over again. So, I mean, again, I'm happy to be wrong here, and maybe if the Fed goes 0 basis points on February 1st, I've got a whole lot of recalculating to do. They only go 25, which is the base case at this point. We'll find out. The end of this week, if 1 month LIBOR is trading at 35 basis points over SOFR, we're going to 50 basis points on February 1st. We're already at 26.
Does that
then
largely
another week to get up to 50 and anticipate that the Fed's going to go 50?
Does that depend on the ECB? Like, what if the guy who said, today said
LIBOR has to anticipate where the Fed is going to go on the day of the Fed funds, on the day of the FOMC meeting, so that there's no rate shock the next day. 1 month LIBOR has to rise to the same level as to where SOFR is going to go, so that there's no dislocation between the two markets on the day that the Fed stepwise raises from 4.5 to 5, right? Then LIBOR has to get there on that day so that they don't have to play catch up the next day and go 25 basis points and have everybody and have to rise 25 basis points in a day and have everybody freak out. So if you watch 1 month, if you go back and look at 1 month LIBOR over SOFR, you'll see this happens every time. And that's how you can almost predict what the Fed's going to do every time. As of right now, the market is still trying to make it look like it's only going to be 25 basis points. And again, it may only be. But the data will be abundantly clear that if we're trading above 25 basis points I think we're at 26 or something like that on Friday. Let me go. I have the chart readily available. Let me just look it up real quick. It won't take me but a second. Boom. Boom. Where were we on Friday? I think I actually did it. We were at 23, I think, on Friday. We are 23 basis points on Friday. So, it's a couple days in arrears. So it's already saying 25 now. And then 3-month LIBOR is already above 50 basis points. So it's saying 225s going forward over the next 3 months. So we'll see what happens. I think I'm going to be right about this, though. Well, I mean, and if so, maybe there's going to be a rate shock. Maybe. What if the Fed comes out? What if the market is completely convinced that the Fed's only going to do 25 and Powell comes out and says 50? Tomorrow, the next day, everything has to shift 25 basis points. Everything. Oops.
How does all that tie in? Because you say it's going to be US centric. How does it tie in into the labor market? I guess that's obviously an important part of the economy. We haven't are we seeing more layoffs than you thought? Less? What do you think?
No, I think we're seeing a whole lot of middle manager layoffs from when the dollar was riskless, and we're seeing a whole lot of buying at the bottom of the economy. There's job openings everywhere for real work to get done, and a lot of people have been sitting around on their ass, either in make work jobs or on unemployment or extended unemployment benefits and all the rest of it. That's part of the reason why. But we have a very tight labor market, and I think that labor market is going to continue to be tight until, again, everybody gets out of the denial that their job as a purple-haired community manager for Twitter is coming back. It's not. It's gone. You better either go marry a. I'm sorry, Tumblerina von Safe Space. It's time for you to either marry a plumber or, take that waitress job over at the Waffle House, honey, because that's your future right now. Because the office job is not coming. Where you get the office job where you get to terrorize MAGA cards, that job's gone, baby. And you get paid $60,000 a year to do it. That job's gone. And drink, lattes on somebody else's dime. Those jobs are not coming back. Not coming back. So they're going to go from purple hair community managers over at Twitter to Waffle House waitresses, where they're going to have to, get rid of the nose ring and everything else, or not, or starve, or marry a plumber who's making $150,000 a year.
Well, you're mentioning plumber,
but what plumber would take her is the bigger question.
What about construction jobs, though? Because if interest rates are going up, I guess housing slows down. I guess I saw somebody make that. That's not my point, by the way. I saw somebody make it on Twitter.
There's a lot. I'm sorry. I didn't mean to jump over you.
Okay.
There's a lot of. There's going to be a rotation in labor in the United States. There has to be. It's not going to be easy. It's not going to be. It's going to. We're going to see some unemployment rise. But why do we believe that the Fed's not willing to allow the unemployment rate not to get to 5%? Why do we believe that recessions are evil? Recessions are the cure. I'm an Austrian. Recessions are the cure. The question is whether or not the Fed's going to survive the political backlash from them doing that. I think they are properly placed at this point. I think they're properly positioned because we are now 4 months away from the presidential cycle opening in the United States. Everybody's going to be declaring, and it's all going to start in June, right? June, July. People who are looking to get reelected, they're going to be trying to figure out how they can get jobs brought back to their towns. They're going to have a plan going forward, and they're going to not want to look like a whole bunch of people who are okay with Antifa trying to burn down Atlanta. We're just done with that crap here in the United States. George Soros is not going to we're not going to have another. And if they try another summer of violence like they tried in 2020, God, are they going to have a problem on their hands? Because they've already destroyed Portland, they've already destroyed Seattle, they've already destroyed California. They try that stuff here. They got a taste of it the other day over the weekend. They tried to burn down. They tried to burn down Atlanta. They all wound up in jail. And the AG is not, and the district attorney, the DA is not going to let them out. So it's everything changes. It's not the same world that we had for the last couple of years. Everybody's worried that the Fed can't handle the political pressure of a recession. I'm telling you, they can, and they can handle our labor market at 5% unemployment or 5.5%. It's not going to all of a sudden go from 3.5 to 6. That's not going to happen. So it's not anybody. No one wants that.
Mm.
So it's not like we're already at 4.5%, and the world hasn't melted down.
You
Everybody's
heard
hoping the
that
world was
along
going to
the
melt
way
down at
too.
1%. We're at 4.5%, and why is it? Why are we're not melting down yet? We're just getting
I
rid of a
heard
whole
that
lot of
along the
frothy
way
credit.
too, and I believed it. I mean, we were like, oh no, the economy breaks at 2.5, 3, 4, 5. Now it's 5. You know, everybody's saying the economy breaks at 5%. Nobody's going to be buying a car. Nobody's going to be able to afford a house. We're not going to eat anything because of the egg shortage and stuff like that. And
That's
I
the
have
bird
a
flu.
feeling that it's going to turn out to be wrong too, because it was for the last 18 months. So
Mm-hmm. I think 2024 is going to be a lot more difficult. I think a lot of these. I think there was an awful lot of liquidity in the system after the CARES Act, and I think everybody kind of missed just how much money was sloshing around.
mm,
That pays for an awful lot of stuff.
mm,
Pays for an awful lot of severance packages,
mm.
and now people are going to have to attenuate. So again, and then they can pay down some debt or do whatever they have to do. Yes, there's a lot of people out there who are putting an awful lot of their life on the credit card. And I'm not saying it's going to be easy. I'm not saying it's going to be the question that everybody has is do they believe that the Fed can't handle the political pressure of a little bit of dislocation? And everybody is all so damn safe space driven that they just don't know how to deal with pain. Like it's nonsense. We know how to deal with pain.
Mm.
And Europe is still functioning, barely, but they're still functioning. Right?
We've not freezed to death either. Our gas reserves are full.
Yeah. Oh, it was a mild. You were lucky. It was a mild winter. Good for you. No, never want to see anybody start. Never want to see anybody freeze. But now understand that that was the grace of something, be it God or whatever you want to call it. You got lucky.
Yeah.
Same policies that were in place that put you in that position this last year are here this year, coming up. So now what? Everybody was worried about Europe freezing in 2023. I was always more worried about Europe freezing winter of 2022. I was always looking ahead to 2023 because now you have to buy the gas and the oil, and are you going to change policy or not? Because you keep putting more policy in place that says we're going to stop, not going to buy from the Russians, or we're not going to buy from this one, or we're going to complain that the Americans are making too much money off of this. I'm like, well, got news for you. You put yourself there. You went along with it, and you listen to Ursula von, and you let Ursula von der Leyen, possibly one of the dumbest people I've ever seen in politics, set your policy for you.
Hey, nobody elected her.
No, and no one elected her, and yet somehow the EU is a bastion of democracy and liberal values and all of this. And I just see the Politburo.
Ah, it's because of all the wind turbines that we have.
Chopping up the birds. And filling and then the old wind turbine blades from the worn out windmills filling up the landfills because those things are not recyclable at all.
Yeah,
but no one looks into that.
That's true. Windmills are actually kind of cool, by the way, because they're kind of self-sustaining. So I like them. I don't like wind turbines though. I mean, the old windmills, like in the Dutch stuff. I think I have one. There's one you cannot see it in the painting, but there's one that used to mill the
No, I mean, look, we've lived in this life where but we moved away from windmills and water wheels for a variety of reasons. It was not reliable energy on a mass scale to do mass industrialization. And the idea is that the implicit message from the environmental industry and obviously from the World Economic Forum and the climate change ninnies and all this is that we have to go back to that, and that's a sustainable world, and no one wants to live like that. You want to go back to the 18th century when wash your clothes in a washboard and hand what are you in your mind? We're not doing that.
Yeah.
I'm sorry. And if you think that we are doing that, then I have two words for you. Jamie Dimon. He's not going to want to live like that, and he's not going to. And he has the ability to go, you know what, Klaus? No, stop it. Just stop. And he has. He went to Davos and literally said, we're going to be using oil 50 years from now, and interest rates are going above 5%.
Yeah.
That guy has real power. Klaus Schwab was removed basically from his own forum after 52 years. It'll be hilarious. But the amount of damage they've already done to the structure of the global economy is so big that we're going to be dealing with the aftershocks of this for years. And the potential here is about these people going nuts and trying to take us to war in order to finally win. That's the last gasp of, this type of person, is they'll get rid of us all by, killing us all off in a war. And I hope that we don't. I hope that doesn't happen, and I hope that the people that I've identified as saying, we don't want to do that, have enough pull to arrest the inertia that we are pushing towards that. And it doesn't look good, but we may get there, and then the end result is not as bad as it could be. I think that's the best we can hope for. So,
yeah, it's kind of funny. Every time we speak, it's almost not almost like it always concludes in gold, goats, and guns. Like you can literally just conclude it into that. Whatever we've spoken about and whatever way we used to come here, and it's just like you end up coming back to this.
Yeah, it's funny. I dude, like, that's the real world. Savings, investment, and hedging and defense. Savings, hedging, defense, over and over and over again. It's not irreality, narrative, froth. You can't. It's savings, industry, and defense. It's not go into fuck around and leave yourself vulnerable, because that's the world that they've created. A vulnerable world where nobody defends themselves. A world built on debt and make work and fake work. It's not it. You have to build real things after you've saved and then defend it like a dog. That's the real world. Gold, goats, and guns. It's the way I look at it.
Yeah, it's a good way to look at it. I'm about to let you enjoy the rest of your cigar there.
Yeah, we're about done. I'm about out of smoke, so then this thing has to come to an end. Otherwise, I got to light another one, and we go for another 2 hours. I'd rather not do that. I don't think my throat can handle that right now.
Let me sort of sum up what I wrote down, and you tell me where I was wrong or what I'm missing. We started off strongly. You said everybody's going to be losing their religion, and that the Fed put is dead, and a lot of these things will be realized. Hopefully, people are going to realize they were wrong going along the TLT too. Who knows? You don't expect the Great Reset to be coming to America because you think that inflation is going to be returning. But you think inflation is going to be returning in a very different way where, as I put it, not you, I called it stupid things are going to be deflating, but the necessary things are going to be inflating. So I wrote down food, shelter, energy, because that makes sense, the real stuff. But it goes back again to gold, goats, and guns. And recession, you do expect a recession, but it's going to be 2024. So you don't expect it to be too soon. And you supported it, by the way, the inflation thing that you said, you supported it by saying commodities are forecasting inflation. Was a good point about aluminum too there. And bear market for bonds is, although it is currently presenting itself as a bull in disguise, you'd say it's still a bear, and it's going to come back after the knee-jerk reaction. And another important point is geopolitics and macro matter together a lot more than people might think. So those are some of the high-level stuff that I wrote down. Is that what I'm missing here?
Not much, other than at this point, what you have to think about is how you can shore up your local communities as best as possible. And it's very important that you realize that in a hollowed-out industrial world, right, a world that's been built on fake money and fake profits and all this stuff, that we've hollowed out the basics of how we build gold, goats, and guns, or however else you want to put it, how you build the real economy. That means that there's going to be massive opportunities in your local economy to rebuild your community, rebuild the strength of your either your family or your local community or whatever, and the local economy. and there's going to be opportunities there that you don't even realize. And people are going to be looking to get real, and that means that they may need, they're going to need things. The things are going to break down. There's going to be repair services are going to be, I think, a good industry, a good, I think repair in some way. It's like repair. If the world is broken, now we have to build. Now we have to repair it. So, however that looks, whatever that theme looks like to you locally, you might find that there's an awful lot of opportunity where you are to repair things, repair that which has been broken. And I think I'm gonna keep pounding that point home as we go forward here. I think the Fed is trying to repair its credibility, and it's trying to repair the dollar. I think that the fiscal conservatives on Capitol Hill are trying to repair the process of legislation on Capitol Hill. I think the BRICS are trying to repair the global economy from, taking it back from the people who have been purveying debt as the way forward, and extracting wealth through debt to get real things. And I think that's a major repair theme. I think if you think of all of these things of what I've discussed today in terms of repairing that which is broken, I think a lot of this starts to really make a lot of sense to you. And so, repair your own personal balance sheets, repair your communities, do what you have to do. And when you're done with it, and it's a long process, and it's going to be slow because capital formation is slow. Capital destruction is easy. Capital destruction happens when somebody drops bombs on you. But building things and keeping things, right? That's hard. Building things that last is hard. So there we go. That's what I got for you.
It was an awesome conversation. Thanks a lot for putting so much time in me. You've been very generous, and I would put a link to Goats and Guns in the description if anybody wants to check your work more in depth. That's where you do. Give me just a quick rundown. What do you do? You even do meetups. What else do you do?
Oh yeah, so we follow me on Twitter at TFL1728, where the worst version of me exists, and I mean that in the nicest possible sense. But the Patreon is designed around twice weekly market reports, where I rant into a microphone and do a chart analysis on all the major strategic markets like gold and silver and Bitcoin and the Dow and whatnot. I also do Patreon requests of reads of what people want to see from me, what they're invested in personally. We do a monthly newsletter which combines forward-looking commentary with a portfolio for the retail investor, ideas about where you should put your money, and I write privately for them as well. So that's all part of the Patreon package. You can find a link to that on my blog over at tomluongo.me or goldgoatsandguns.com. And then I at the same time put out a podcast, but it's all just kind of in service of the same thing, which is to drive people to the Patreon and then help build the community. We just did our first meetup with the patrons, which they drove, which was great, on Saturday night, and it was a lovely time. We were down in Orlando, and lovely time having dinner with some of my people, and it was great. And they got to tell me thank you, and I got to just sit there and go, no, thank you. And it was all about them. And I just turned it right back on them because that's what it was, because it's all about them. So
awesome. Tom, I really appreciate you. Thank you for doing this.
Appreciate it. Hey, you have a great day now. We'll talk soon.